What if I told you that three of the biggest shocks to the global financial system didn't arrive months apart? They hit almost at the same time? A wave of permanent tariffs, hundreds of billions of dollars erased from America's biggest technology companies, and oil prices racing past the psychological $100 level. Is this just another temporary market panic, or are we watching the early stages of something much bigger? And perhaps the most important question for anyone holding precious metals. If all of this is happening together, why did gold fall instead of exploding higher? Even more importantly, can gold really defend the $4,000 level, or is an even larger move still waiting around the corner? Right now, investors everywhere are asking the same question. Something doesn't feel normal anymore. Markets have survived inflation scares, banking crises, wars, pandemics, and aggressive interest rate cycles. But what happens when several major risks begin stacking on top of one another instead of arriving one at a time? Let's start with the first shock. Permanent tariffs are not just another political headline. Markets often react dramatically when trade policies become long-term rather than temporary. Why? Because permanent tariffs don't simply raise the price of imported goods. They change business decisions, supply chains, investment plans, manufacturing strategies, and consumer prices for years instead of months. Imagine being the CEO of a multinational company. If you know tariffs are only temporary, you might simply absorb the cost and wait. But if you believe those tariffs will stay for years, everything changes. Companies begin relocating factories, suppliers get replaced, shipping routes change, production costs rise. Consumers eventually pay higher prices. And here's the important question. What does that create? Inflation. Not necessarily overnight, but gradually. That's where things become interesting for gold investors. Gold has historically performed well during periods when investors begin questioning the purchasing power of paper currencies. If businesses continue passing higher costs to consumers, inflation pressure may remain stronger than many central banks would prefer. But then another question appears. If inflation is supportive for gold, why wasn't gold immediately soaring? The answer lies inside another market that often receives less attention than it deserves. The bond market. Whenever uncertainty suddenly rises, investors don't immediately buy only gold. Large institutions often rush into U.S. Treasury bonds first because they remain one of the world's most liquid safe haven assets. That initial move can strengthen the U.S. dollar, especially if Treasury yields remain attractive. And here's something many retail investors overlook. A stronger dollar often creates temporary pressure on gold prices because gold is priced globally in dollars. That doesn't necessarily change gold's long-term outlook. It simply creates short-term volatility while investors decide which safe haven they trust more. Now combine that with the second shock. America's largest technology companies suddenly losing around $800 billion in market value. That's not just another red day on Wall Street. Those companies represent an enormous percentage of major stock indexes. Pension funds own them. ETFs own them. Retirement accounts own them. Mutual funds own them. Individual investors own them. When the biggest companies begin losing massive amounts of value in a short period, confidence starts changing. Confidence is one of the most valuable assets in financial markets. Without confidence, investors stop asking, "How much money can I make?" Instead, they begin asking, "How much money can I protect?" That small psychological shift changes everything. History has shown this repeatedly. During periods of extreme optimism, investors chase growth. During periods of uncertainty, investors chase safety. So where does safety usually lead? Government bonds, cash, gold, sometimes the US dollar, and occasionally silver. Notice something interesting? Silver doesn't always react exactly like gold. Why? Because silver wears two different hats. It's a precious metal, but it's also an industrial metal. That means silver depends not only on investor fear, but also on manufacturing demand. If tariffs slow global trade and economic growth, industrial demand for silver could temporarily weaken. But here's the twist. If governments respond with more stimulus, easier monetary policy, or renewed infrastructure spending later, silver often benefits much faster than many investors expect because industrial demand begins recovering while investment demand also rises. That's one reason silver has historically experienced much larger percentage moves than gold once momentum returns. Now let's add the third shock. Oil climbing above $100. Why is oil so important? because almost everything in the global economy depends on energy, transportation, manufacturing, agriculture, mining, shipping, air travel, construction. Even food prices eventually feel the impact. Higher oil prices work their way through nearly every supply chain. Now ask yourself another question. If transportation becomes more expensive, factories become more expensive, shipping becomes more expensive, does inflation disappear, or does it become harder to control? This is exactly the type of environment central banks dislike, because they suddenly face a difficult decision. Should they keep interest rates high to fight inflation? Or should they cut rates to support slowing economic growth? Doing both at the same time is nearly impossible. That's why economists often describe this kind of situation as one of the most difficult environments for monetary policy. And markets hate uncertainty. Whenever investors lose confidence in knowing what central banks might do next, volatility usually increases. Volatility itself becomes another catalyst for safe haven assets. But something else deserves attention. Many investors focus only on headlines. Professional investors watch liquidity. Liquidity determines how easily money moves through financial markets. When liquidity begins tightening, risk assets often struggle. Technology stocks, high-growth companies, speculative investments, even cryptocurrencies. But when central banks eventually reverse course and begin injecting liquidity back into the financial system, precious metals have often benefited. Does history guarantee it will happen again? No. Markets never repeat perfectly, but they often rhyme. Now let's think about gold's recent pullback. A 2% decline sounds dramatic in headlines. But step back. Gold had already experienced an extraordinary rally before facing this correction. Strong trends rarely move in a straight line. Healthy markets breathe. They rise. They pause. They correct. Then investors decide whether the larger trend remains intact. Professional traders understand this. Retail investors often panic. That's one reason corrections frequently shake out weak hands before stronger trends continue. Does that mean gold must immediately recover? Not necessarily. Could it test lower support levels first? Absolutely. Financial markets rarely move exactly how the majority expects. In fact, the biggest rallies often begin when confidence is lowest. Think about previous financial crises. How many people believed gold would eventually reach new record highs during the middle of those panics? Very few. Most people were focused on surviving the current crisis. Only later did they recognize what had actually been happening beneath the surface. That's why experienced investors constantly ask a different question. Instead of asking, "What happened today?" they ask, "What is changing underneath the headlines?" And right now, several important changes appear to be happening simultaneously. Global trade relationships remain uncertain. Government debt continues expanding. Energy prices are becoming more volatile. Geopolitical tensions remain elevated. Central banks continue balancing inflation against economic growth, and institutional investors are paying extremely close attention to all of it, because they understand something many people don't. Major financial turning points rarely announce themselves with a single event. Instead, they build quietly. One pressure after another. One policy change after another. One market reaction after another. Until suddenly, everyone realizes the financial landscape has already changed. The question now isn't simply whether stocks recover next week or whether oil falls back below $100. The real question is whether these developments are temporary disturbances or the early signals of a much larger shift in how global capital moves between risk assets and safe havens. That brings us to the question almost every precious metals investor is asking right now. If fear is growing, inflation risks are rising, and uncertainty seems to be spreading across multiple markets, why isn't gold already racing toward new highs? The answer is more complicated than most headlines suggest. Financial markets don't move based on one single factor. They move based on which force is strongest at any given moment. Sometimes inflation dominates the story. Other times it's interest rates. Then suddenly, the US dollar takes control, and occasionally, liquidity becomes the only thing that matters. Think about what happens during the first stage of a major market shock. Investors don't immediately sit down and carefully decide where to put their money. They react emotionally. Portfolio managers receive margin calls. Hedge funds reduce leverage. Institutions sell profitable positions to cover losses elsewhere. Cash suddenly becomes king. That's why even gold can temporarily decline during periods of market stress. Does that mean investors no longer believe in gold? Not at all. It simply means liquidity comes first. History has shown this more than once. During the early stages of several major financial crises, investors sold almost everything, including assets they still believed in, because raising cash became the immediate priority. Once the panic began settling, attention shifted from survival to preservation, and that's often when precious metals regained momentum. Could something similar happen again? It's certainly possible. Now let's look at another piece of the puzzle that rarely gets enough attention: central banks. For years, central banks around the world have steadily increased their gold reserves. Why would institutions managing national reserves continue buying an asset that pays no interest? Because gold serves a different purpose. It isn't purchased for quarterly returns. It's purchased for long-term monetary stability. Gold doesn't depend on the earnings of a corporation. It doesn't rely on a government keeping inflation under control. It doesn't carry the same credit risk as bonds. Instead, it functions as a store of value during periods when confidence in financial assets begins to weaken. That doesn't mean central banks buy gold every single month without interruption. Purchases fluctuate, and different countries have different reserve strategies. But the broader trend over recent years has shown that many monetary authorities continue to view gold as an important reserve asset. Now ask yourself another question. If institutions responsible for managing national reserves still see value in holding gold, what does that suggest about the long-term role of the metal? It doesn't guarantee higher prices tomorrow, but it does suggest that gold continues to play an important role in the global financial system. Silver, however, tells a slightly different story. Unlike gold, silver depends heavily on industrial demand. Solar panels, electric vehicles, electronics, medical equipment, artificial intelligence infrastructure, data centers, power grids. Modern economies consume silver in thousands of applications. That means silver often experiences stronger price swings than gold because it's influenced by both investment demand and industrial activity. Imagine two powerful forces pulling in opposite directions. On one side, slower economic growth could reduce industrial consumption. On the other, rising financial uncertainty could increase investment demand. Which force wins? That's exactly what the market is trying to determine. And this is why silver sometimes appears confusing. It can underperform gold during periods of economic fear, then suddenly outperform once investors begin anticipating recovery, monetary easing, or stronger industrial demand. For long-term investors, understanding that difference is critical. Now let's shift our attention back to oil. Many people think higher oil prices only affect gasoline. The reality is much broader. Mining companies consume enormous amounts of energy. Transportation companies rely on fuel. Factories require electricity. Global shipping depends on diesel and marine fuel. If energy remains expensive for an extended period, production costs increase across multiple industries, including mining itself. That creates an interesting situation. What happens if producing precious metals becomes more expensive while demand remains strong? Mining companies don't simply increase supply overnight. Opening a new mine takes years. Permits, environmental reviews, infrastructure, equipment, skilled labor, capital investment. It's one of the slowest industries when it comes to responding to higher prices. This supply lag has historically played a major role during commodity bull markets. Demand can change quickly. Supply usually cannot. That's one reason commodity cycles often last longer than many investors expect. But let's return to Wall Street for a moment. The loss of roughly $800 billion among the largest technology companies wasn't simply about stock prices falling. It reflected changing expectations. Markets constantly price in future earnings, future growth, future interest rates, future consumer spending. When expectations shift, valuations adjust. Some investors immediately ask, is this the beginning of another major bear market? The honest answer is, nobody knows. Anyone claiming certainty about short-term market direction is guessing. What we can analyze are probabilities. If economic growth slows while inflation remains elevated, corporate profits may face additional pressure. If interest rates remain higher for longer, borrowing becomes more expensive. If borrowing becomes more expensive, business investment may slow. If business investment slows, earnings expectations can change. Notice how everything connects? That's why professional investors rarely study one market in isolation. They watch bonds, currencies, energy, commodities, equities, credit markets, central bank policy. Each one provides another clue. Now think about the US dollar. During periods of global uncertainty, international investors often move money into dollar-denominated assets. That demand can strengthen the dollar, and as we discussed earlier, a stronger dollar sometimes creates temporary headwinds for gold. But what happens if investors eventually begin believing the Federal Reserve will have to reduce interest rates to support economic activity? That expectation could weaken the dollar over time. And historically, a weaker dollar has often provided support for precious metals. Again, nothing is guaranteed. Markets constantly evolve. But understanding these relationships helps investors avoid reacting emotionally to every headline. Let's talk about psychology for a moment. Fear spreads much faster than confidence. One negative headline creates another, then another. Financial television begins discussing recession risks. Social media fills with predictions of collapse. Investors who were optimistic a week earlier suddenly become defensive. This emotional cycle repeats throughout history. The names change, the headlines change, the technology changes. Human psychology does not. That's why experienced investors try to separate emotion from evidence. Instead of asking, "How do I feel?" they ask, "What do the data actually show?" Right now, the evidence suggests that markets are dealing with multiple sources of uncertainty at the same time. Trade policy, energy prices, corporate valuations, inflation concerns, interest rate expectations, geopolitical risks, government debt, currency movements, each one alone would matter. Together, they create a much more complicated investment environment, and that's exactly why the next move in gold could become one of the most closely watched stories in global finance. Because if confidence continues deteriorating while inflation refuses to disappear, investors may begin searching for assets that have historically preserved purchasing power during periods of prolonged uncertainty. The critical question is no longer whether volatility exists. Volatility is already here. The real question is whether this is simply another correction within a healthy financial system, or the beginning of a much larger shift that changes where global capital chooses to hide when uncertainty reaches its highest level. That brings us to the question every precious metals investor is waiting to answer. Can gold actually defend the $4,000 level? At first glance, the answer seems simple. If tariffs remain in place, oil stays elevated, inflation proves stubborn, and investors become increasingly nervous about equities, then gold should continue benefiting from safe haven demand. But markets are never that straightforward. Imagine two powerful forces pulling against each other. On one side, inflation remains higher than policymakers would like. Energy prices increase production costs, governments continue running large budget deficits, and geopolitical uncertainty refuses to fade. Those factors have historically been supportive for gold. On the other side, if the US dollar stays strong and interest rates remain elevated for longer than expected, gold could continue facing temporary pressure. Investors earning attractive yields on cash or government bonds may delay moving more money into precious metals. So which force wins? The answer depends on what changes first. If inflation begins cooling rapidly while economic growth stabilizes, investors may regain confidence in equities, reducing some demand for safe haven assets. But if inflation remains persistent while growth weakens, the picture changes dramatically. Economists often refer to that environment as one of the most challenging scenarios for policymakers. Central banks are forced to balance two competing priorities: controlling inflation while avoiding unnecessary damage to the economy. History has shown that these periods are rarely smooth. Markets become volatile. Investor expectations change quickly. Large institutions rotate capital from one asset class to another, and that's where precious metals often return to the center of attention. Now let's talk about something many retail investors overlook. Gold doesn't need every headline to be bullish. It doesn't require a crisis every single day. Instead, gold often performs best when confidence slowly erodes over months rather than collapsing overnight. Why? Because institutional money moves differently than retail money. Large pension funds don't wake up one morning and suddenly move billions of dollars into gold. Insurance companies don't completely change their portfolios because of one trading session. Central banks certainly don't. They build positions gradually. They evaluate risk over years, not days. That slow accumulation can become a powerful force beneath the surface, even while daily price movements appear confusing. Silver, however, can tell a very different story. If gold attracts defensive capital, silver often waits for something else: momentum, industrial recovery, improving manufacturing activity. or simply stronger investor confidence that the precious metals cycle has entered a new phase. When those conditions align, silver has historically produced larger percentage gains than gold because of its smaller market size and dual role as both an industrial and monetary metal. Of course, that also means silver tends to experience deeper corrections. Higher potential reward often comes with higher volatility. That's why experienced investors understand the difference between volatility and long-term direction. A volatile asset isn't necessarily a weak asset. Sometimes it's simply responding to multiple forces at the same time. Now consider another important factor: global debt. Governments around the world continue carrying historically high debt burdens. Servicing that debt becomes increasingly expensive when interest rates remain elevated. Eventually, policymakers face difficult choices: raise taxes, reduce spending, increase borrowing, or allow inflation to gradually reduce the real value of outstanding debt. None of those options are painless. Markets understand this. That's one reason many long-term investors continue allocating at least part of their portfolios to tangible assets like gold. Not because they expect the financial system to collapse tomorrow, but because diversification matters when uncertainty increases. Let's return to the $4,000 question. Could gold temporarily fall below that level? Absolutely. No technical support level is guaranteed. Financial markets frequently overshoot in both directions. Stops get triggered, emotions take over, algorithmic trading accelerates moves. That's normal market behavior. But the more important question isn't whether gold touches a certain number during periods of volatility. The real question is whether the fundamental reasons investors own gold have changed. Has inflation disappeared? Not entirely. Have geopolitical tensions vanished? No. Have governments stopped accumulating debt? No. Have central banks suddenly abandoned gold as a reserve asset? Again, no. Those underlying drivers remain part of today's financial landscape. That doesn't automatically guarantee higher prices tomorrow morning, but it does explain why many long-term investors continue paying close attention to every correction rather than assuming the larger trend has ended. And what about silver? Could silver eventually outperform gold? History suggests it often has during the later stages of precious metals bull markets. Once confidence returns to the sector, investors looking for greater upside frequently rotate toward silver. Again, timing matters. Nothing moves in a straight line, but understanding where silver fits within the broader precious metals cycle helps explain why many experienced investors monitor both metals rather than focusing on only one. Now step back and look at everything we've discussed. Permanent tariffs affecting global trade. Oil prices pushing above $100. Major technology companies losing hundreds of billions in market value. Persistent inflation concerns. Interest rate uncertainty. Central bank policy, government debt, currency movements, safe haven demand. Individually, each story deserves attention. Together, they paint a picture of a financial system entering a period of significantly higher uncertainty. Does that automatically mean a full-scale financial crisis is inevitable? No. Markets have weathered major shocks before. Economies adapt, businesses adjust, policymakers respond. But ignoring these signals would be just as dangerous as overreacting to them. The smartest investors rarely make decisions based on fear alone. They prepare, they diversify, they focus on evidence rather than emotion. They understand that preserving capital during uncertain periods can be just as important as maximizing returns during bull markets. So, can gold defend $4,000? Based on the current macroeconomic backdrop, that level has a logical fundamental foundation. Persistent inflation risks, elevated geopolitical uncertainty, ongoing central bank interest in gold, and the search for safe haven assets all provide meaningful long-term support. However, short-term price action will still depend on interest rates, Treasury yields, the strength of the US dollar, and overall market liquidity. If those headwinds remain strong, gold could experience additional volatility before establishing a durable base. But if inflation stays sticky, economic growth weakens, or financial stress deepens, the demand for defensive assets could strengthen once again. As for silver, its path may be more volatile, but if industrial demand stabilizes while investment demand accelerates alongside gold, silver could ultimately become one of the strongest performing major commodities in the next phase of the cycle. The biggest mistake investors can make right now isn't being too optimistic or too pessimistic. It's assuming that the world hasn't changed, because whether gold holds $4,000 immediately or tests investors' patience first, One thing is becoming increasingly clear. The global financial landscape is entering a period where understanding macroeconomics, central bank policy, and precious metals has never been more important. Those who stay informed, remain disciplined, and focus on long-term fundamentals instead of daily headlines will be in a much stronger position to navigate whatever comes next.